Okay, the next is looking at risks, macro risks. One of the biggest risks is inflation and inflation volatility. And when we went through the discount rate, building the discount rate, the inflation risk premium, well, here's the inflation risk premium right here. As you can see, between 80 and really 1990, high volatility for about 11 years, high volatility. This is the month-to-month change in the CPI index. Okay, you can see the range in volatility in inflation. So there was very high inflation risk premiums in the discount rates during this 11-year period. Then you had very stable price volatility during the 90 to 98 period. So you saw the volatility in inflation really shrink. It created some stability in prices. And actually this time period in here was one of the fastest growth periods in employment and GDP at very low inflation rates and very high stock price appreciation during this time period. This was the bull period across the board. It was really the honeymoon period. Then you really saw in 2000, with the deregulation and instability in the Middle East, you really saw the transmission of oil price volatility start to manifest and transfer through to the CPI index. And if you look at the volatility of inflation now, it looks like the volatility of inflation in the 1980s and the early 90s. So inflation risk premiums are actually higher now than they were in the most recent history. I don't think that inflation risk premiums are actually being taken into consideration or truly reflected in the discount rate. Let's look at other inflation proxies. Oil prices. Oil prices were actually very low. They traded around $25 for decades between the 90s and all the way up through 2000. Very stable, $25 per barrel. Then really in 2000, you saw oil prices, commoditization, huge participation by Wall Street in oil futures contracts, instability out of the Middle East, rapid growth of China, and you saw just spikes in volatility in oil prices. And now oil prices have reverted back to their $50 range per barrel. So oil prices now are where they were in the early 2000 period. And I think this volatility and these oil prices were artificially propped up due to too much money in the futures market and speculation in the oil markets and restrictions on supply, artificial restrictions on supply. So now you're seeing an unwinding of this speculative volatility period focused around oil prices. And as oil prices have come down, it's being passed through to consumers, and they have more money now, and they'll take that money and spend it. So the oil companies and the oil markets were capturing a lot of the consumption, a lot of the available income that was available to consumers, and now that will be released at lower oil prices. But I do believe that volatility in oil prices will continue to be the nature of the pricing. Gold. Gold is another proxy for inflation. It's a store of wealth. It's a hard asset. You probably want to be in gold if your currencies are devaluing because of inflation. It's an inflation hedge. It's a proxy instrument. People go into gold when they're scared and when they think their currencies are going to devalue and their purchasing power is going to be eroded by inflation. So gold, as you can see from the chart, was fairly stable, in 01, 02, and then really took off in 06, 07, 8, and 9, corrected period during the recession, took off again, reached another all-time peak, and basically has corrected back. And this is an older chart, but it's basically been in a trading range since 2013. So almost 2 years, 3 years that gold has been in a trading range, has not moved up because of precaution or devaluation. Actually, the opposite's true. The US currency is appreciated, not depreciated over the last year and a half. And gold as a proxy for inflation is indicating disinflation or deflation. And a lot of speculators bid it up, gold and gold prices. And when it looked like the equity markets were turning, they sold off their bond portfolios, they sold off their gold portfolios, which was overvalued, and moved the money into equities. And that's why you saw the equity market do so well over the last 2-3 years. Volatility is a reflection of risk. This is the VIX index, which is a measure of the equity stock price volatility, the volatility in the S&P 500. And you can trade this. You can go long or short volatility. You can write and buy futures. You can write and buy options on the futures based on the VIX index as a hedge and or to take advantage of the situation. As you can see, during the dot-com bust, you had some pretty high volatility in the VIX index. High volatility post-dot-com. And then the volatility started to fall. And you actually saw very low volatility in 05 and 06 as the stock market was appreciating rapidly. The volatility was being squeezed out of the market. And then leading up to 08 and 09, you can see how the volatility just exploded. Blew through the resistance lines on the volatility index in the early 2000 period and reached extreme heights in 08, 09. If you lived through 08, 09, bond price volatility, stock price volatility, home price volatility was the norm and just blew out the index. And actually you couldn't even trade this index on the futures or the option side because the premiums. Remember, volatility is the number one factor that drives option premiums. You couldn't even buy the options because the premiums were so expensive. And then as you can see, volatility came back down at the resistance level, so a new support, and then you got another spike in 10 and 11. So the VIX index is a good reflection of volatility in the marketplace. When it's low, you see a lot of IPOs, you see a lot of stock price appreciation, you see a lot of movement into the stock market. When it's high, you see money coming out of the market and into the bond market. But this is really what's telling is the degree of volatility that investors were subjected to in the 08-09 period. Volatility never seen before. And that this 08-09 recession was a lot of firsts. It was the most volatile, the most destructive recession market environment that we've witnessed since 1958, and you got to go back to the Great Depression to find other analogies of so much destruction and volatility. So let's cut it and we'll start again.